The U.S. government is paying $1 trillion a year just in interest on its own debt. Not for schools, not for hospitals, not for roads, just interest. That is more than the entire Pentagon budget, more than Medicare. And the bill gets bigger every single year. Here is the terrifying part. Nobody planned this. Nobody voted for it. It just happened. Slowly, quietly. And right now, nobody knows how to stop it. Let us go back to 2008 for a moment. You probably know the story. Banks got greedy. They handed out home loans to anyone who walked through the door. People with no income, no savings, no real ability to pay. Then they bundled those bad loans into fancy financial products, gave them respectable names, slapped a top-tier safety rating on them, and sold them to pension funds, insurance companies, and regular investors around the world. What could go wrong? Everything went wrong. When the housing market collapsed, the entire global financial system came down with it. Lehman Brothers, a bank that had survived the Civil War, 2 world wars, and the Great Depression, filed for bankruptcy in a single weekend in September 2008. The stock market lost half its value. 8 million Americans lost their jobs. Millions of families lost their homes. It was the worst financial disaster since the 1930s. And after every crash, people say the same thing. We learned our lesson. We fixed the problem. This will never happen again. They said it after 1929. They said it after 2000. They said it after 2008. So here we are in 2026. And the question that serious people on Wall Street are quietly asking, the question nobody wants to say too loudly, is this: what if the next one is bigger? In early 2026, total U.S. national debt crossed $38.5 trillion. That number is so large, it almost stops meaning anything. So let us make it real. The debt is growing at roughly $74,000 per second. Right now, as you watch this, the number keeps climbing. But the size of the debt is not even the scariest part. The scariest part is what happens next. The government has to pay interest on that debt. And right now, those interest payments have crossed $1 trillion per year for the first time in American history. That is more than the country spends on its military, more than it spends on Medicare. And here's where it becomes a trap. To pay that interest, the government has to borrow more money. And borrowing more money creates more debt, which creates more interest, which requires more borrowing. Economists have a name for this. They call it a debt spiral. It is the same reason ordinary people go broke, except this time it is happening to the most powerful government on Earth. In 2008, the crisis started because banks had borrowed too much money they could not pay back. That was a private sector problem. Governments stepped in, wrote big checks, and eventually stabilized things. But what happens when the problem is the government itself? Who steps in to save the government? There is no backup plan for that. Here is what actually stopped the bleeding in 2008. The Federal Reserve slashed interest rates almost to zero. Then it created trillions of new dollars and used them to buy troubled assets from banks. The strategy was controversial. A lot of people hated it, but it worked because the Fed had room to act. Now look at where we are today. Interest rates are still high, hovering around 4.25%. Inflation has come down, but it is not fully under control. The Fed is stuck between 2 bad choices. If it cuts rates too fast, inflation could surge back. If it keeps rates high, it slowly chokes the economy. The fire extinguisher is half empty, and there is smoke coming from the ceiling. In 2008, the ticking time bomb was subprime mortgages, bad home loans dressed up as safe investments. Today, the concern is something called private credit. Private credit is a shadow banking system. It is non-bank institutions, things like private equity firms and asset managers, lending money to companies outside the normal banking rules. Less oversight, less transparency, less regulation. This market has grown to $2 trillion, and it is expanding fast. To be fair, most financial analysts today do not think private credit alone would bring down the global system. The risks are real, but they are not the same as 2007. The loans are not as fraudulent, the leverage is not as extreme. But here's the point. The danger in 2026 is not one giant bomb. It is 5 smaller fires burning at the same time. Private credit stress, runaway government debt, trade war disruption, a weakening dollar, rising tension between the world's biggest economies. 5 separate problems. No single clear solution. And the people in charge are all pointing fingers at each other. For 80 years, the US dollar has sat at the center of the global economy. Countries buy oil in dollars, countries hold dollars as reserves. When the world gets scared, it runs to the dollar. That privilege is enormous. It lets America borrow cheaply and spend beyond its means in ways no other country could. But that privilege is quietly eroding. The dollar's share of global foreign exchange reserves has dropped from 73% in 2001 to around 57% today. Its lowest level since 1994. Central banks around the world are slowly, carefully moving some of their reserves into gold, into other currencies, into anything that is not American. Meanwhile, a group of countries that includes Brazil, Russia, India, China, South Africa, and more than a dozen others, representing about 40% of global economic output, are building payment systems that bypass the dollar entirely. Not because they hate America, just because they want options. On top of that, the tariffs introduced by the Trump administration in 2025 and 2026 became the largest tax increase on American households since 1993. The average family is paying about $1,500 more per year because of them. Trading partners around the world have been rattled, and when the world trusts you less, it needs your currency less. This is not a collapse. It is a slow leak. But slow leaks sink ships too. Here is a detail that should make anyone nervous. In March 2026, Bank of America's chief investment strategist sent a note to clients saying that the way financial markets are behaving right now looks uncomfortably similar to the period between mid-2007 and mid-2008. Not 2001, not 2020. The year before everything collapsed. That is not a prediction, it is a pattern, and patterns in finance have a way of completing themselves. Let us imagine, not the worst case, just a bad case. Private credit funds start showing cracks. A few of them freeze withdrawals. Investors cannot get their money out. Confidence starts to shake. The dollar drops because global investors are already nervous about American debt. U.S. Treasury bond yields spike, meaning the government suddenly has to pay even more interest, which makes the debt spiral spin faster. The Federal Reserve wants to cut rates to calm things down, but cutting rates might bring inflation back, so they hesitate. Markets hate uncertainty. Then a major bank reports unexpected losses tied to risky corporate loans. The word contagion starts appearing in financial headlines. Then on television, then in everyone's group chats. People start asking who is exposed, how much they owe, whether their savings are safe. And nobody has a clean answer. That is not fiction, that is just the script of every financial crisis in history. The specific details change, the psychology does not. Financial crises do not stay in spreadsheets, they land on kitchen tables. When 2008 hit, 8 million Americans lost their jobs. Not investment bankers, teachers, nurses, construction workers, small business owners who had spent decades building something only to watch it disappear in months. If the U.S. government's debt becomes unmanageable, the first response is spending cuts. On public services, on infrastructure, on the things ordinary people depend on every day. The Congressional Budget Office projects that by 2030, U.S. federal debt will exceed 108% of the country's annual economic output. That would break the previous record set in 1946, right after the most expensive war in human history. We would be more in debt than we were after World War II. Not because of a war, just because of the way things have been going. In 2008, the problem came from private institutions taking reckless risks. Banks, investment firms, mortgage lenders. The government stepped in and saved the system. The bill was enormous, but the system survived. In 2026, the risks are different. The government itself is the one carrying the heaviest load. And if a crisis starts there, the normal rescue tools may not work. You cannot bail out the institution that does the bailing out. That is the new problem. And it is one that does not have a clean historical precedent. None of this means a crash is coming tomorrow. The U.S. economy is more resilient than most people give it credit for. The dollar still has no serious rival. American institutions, for all their problems, still function. But the margin for error is much thinner than it was 15 years ago. In 2008, the crisis came from the private sector being reckless, and the government had the tools and the credibility to respond. That combination saved the global economy. In 2026, if the problem is the government itself, and the tools are depleted and trust in American institutions is worn thin, then the question is not whether the system is strong enough to handle a shock. The question is whether there is anyone left to catch it when it falls. The four most dangerous words in investing are these: this time is different. Those words have been wrong every single time in history. The only question is whether we are repeating a mistake we have made before or making a brand new one.